years back during British Raj, when there was a pandemic called plague. But I'm sure the scales must be very different as compared to today. And these unprecedented times calls for unprecedented course of actions. And at BCAS, let me share with you what we have done. So at BCAS, which is a charitable organization with 71 years of presence and around 9,000 members all over India, and engage into continuous knowledge sharing. Uh, there are certain positive aspects which we realized during this COVID-19 situation. Let me share with you for about the same. Normally, under normal circumstances, what we would have done in last 1 month is we might have arranged around 10 to 12 programs, events, conferences, lectures, etc. Whereas in last 1 month, we have arranged definitely more than 20, and out of that, three have been arranged by International Taxation Committee under the leadership of Mayurbhai, and there is one more which is going to come in the coming week. Secondly, normally our attendance, physical plus online, is in the range of 150 to 200, whereas in the meetings which we have done under this COVID-19 situation, the attendance ranges 500 has become a very normal attendance, and it has gone up to 700, 800 also. Thirdly, BCAJ, a mouthpiece, a journal, monthly journal of BCA, for the first time for the month of April 2020, we did not send a physical copy. We could not send a physical copy. So what we did is we uploaded the same on our website, on LinkedIn, on Facebook, and therefore it is available. It was made available to a world at large. This was done for the first time. We have large follower base on YouTube, more particularly LinkedIn, Facebook, Twitter, on our BCA's global platform. Uh, so BCAS has demonstrated its flexibility under the current situation. And with this background, as a vice president of this society, I'll take this opportunity to request all the chartered accountants who are present to become the member of this august body, and those who are already members, please renew your membership. It has become already due, and join this journey, participate this journey of knowledge sharing. Now let me come to the in short about today's speakers and the subject. Mayurbhai will deal with it more at length. Mr. Sanjeev Sharma, who is an IRS and Principal Director Investigation, is joining us from Delhi. Mr. Kunj Vaidya is joining us from Chennai, and Mr. Vaman Kale, which we must thank him from our bottom of the heart for coming in at a last moment because of a particular situation. He's joining us from Mumbai. So I welcome all of you. And this is a kind of national integration, which Mayurbhai said, it's a national integration which is possible only because of a technological advancement. The speakers are going to deliberate upon the effects of COVID-19 on transfer pricing and determination of ALP, arm's length pricing, and planning for the future. They are also going to touch upon certain MLI aspects. Uh, but one thought is definite, which Mayurbhai shared with me yesterday, that this could be an opportunity for India to relax various regulations, including the transfer pricing regulation, to attract foreign investment, which will help us to maintain and generate employment, which is the need of the hour. And if India could do it, it can really become a Y2K moment for all of us. So let's hope and pray that we take up this opportunity. With these short remarks, I welcome and thank you all of you again. And I pass on the proceedings to Mayurbhai to take it forward. Thank you so much.
Thank you, Suhas. Once more, welcome to all of you to the panel discussion on impact of COVID-19 on transfer pricing and planning for the future. Friends, we all know that COVID-19 has impacted not only India but the entire world. The businesses are to the minimum right now. Economic activities are at the bottom low. In the current scenario, there are pressures on margins. There are pressure on various activities which even otherwise can be taken more so in case of associated enterprises. And we need to benchmark the transactions between associated enterprises. The impact of COVID is likely to be lasting not for the few months of lockdown, but even beyond that. Under this scenario, how do we benchmark? What documentation we need to keep? Because the transfer pricing assessment will come after 2 years down the line. What were the circumstances under which the transactions were entered into? How do you document contemporaneous nature of it? And there are a host of issues which would arise, which needs to be addressed, needs to be understood first, and then one has to take necessary measures. And in order to understand and find solutions to various issues, the committee thought of this panel discussion. We have BEPS action plans, and there also there are mention about the valuation of intangibles. Now, does brand have any impact in the current scenario? Where is the market? What is the role of market? We have pillar one talking about new nexus, wherein the market is given importance. Now, how do you benchmark in the current scenario where there is no real market forces working to its maximum, to its fullest, and therefore to determine arm's length prices would itself would be a very big challenge for all of us. As Suhas rightly mentioned, can we take this COVID-19 as advantage India? Can we do some unique or take some unique measures as a country to attract foreign investment? Because India per se is not very much impacted by the COVID-19 so far. And not only that, we have a big market. And therefore, if India can take a lead and relax, its regulations, perhaps we have a big opportunity lying ahead. Another reason is that we need to generate employment. And that is one of the worst effects which is going to be of the COVID-19. So in order to address all these issues, we thought it fit that, we have this panel discussion, and I welcome our distinguished panel, Mr. Sanjeev Sharma, IRS officer. Needless to say that whatever he would be discussing today would be his personal views and not official views from the government department. He has been, sharing his knowledge, BCAS members on various platforms, on various times, and these are all academic, discussion. Looking at his vast experience in representing India at various international forums, we are sure that we will have a very fruitful knowledge sharing from him. We have CA Kunj Vaidya, again, a very learned and eminent chartered accountant from Chennai. Is a partner in PwC, and we have CA Vaman Kale. I must thank Vaman Kale for stepping it because there was some death in the family of Bhavesh Dedia, and he could not, come for the panel discussion. Vaman is a partner in BSR and Company LLP, and he has been in the field of profession, in the field of chartered accountancy for more than 2 decades. He has vast experience in advising local and multinational clients, and in the field of transfer pricing. I'm sure that with his vast knowledge, he would be able to guide all of us and take this panel discussion further. May I request Vaman to take over and start the panel discussion. Thank you very much. Thanks to all of you again, once more, for joining in. Thank you.
Thank you, Mayur Bhai. So as tax professionals, if you look at the last couple of years, we have perhaps witnessed the greatest overhaul of the international taxation system. And as such, we have been facing with a lot of these opportunities, challenges which we've been dealing with, be it arising from the BEPS action plan implementation, introduction of MLI, elevated reporting standards like master file, country by country reporting, and more recently, initiatives taken around the digitalized economy, which have been loosely referred to as BEPS 2.0. So as we were, any case, grappling through all these changes as tax professionals, now we've been hit with this new curveball, so to speak, which is in the form of this COVID-19 pandemic, which has hit the world economy. It is being considered as perhaps far worse than any recession that has happened in recent memory. And very often parallels are being drawn to the Great Depression that the world witnessed in the 1930s. If one looks at almost any macroeconomic or other metric, without exception, there has been a hit, be it a GDP growth, be it employment, be it stock market indices, be it oil prices, bond yields, everything is down. One has to just look at in what have been the lessons that we could have drawn from some of the downturns that we've had in the fairly recent memory. So if you look at the Asian crisis of the late 90s, if you look at the dot-com bust, you look at 9/11, or more recently, the credit crisis in 2008. In all these situations, perhaps the impact that we felt in India was significantly less than what we are likely to have now, given the fact that there is a huge impact in economic terms arising from the lockdown. Businesses have been shut down. So there is going to be a very, very severe impact on the economy. At the same time, it is going to also present India with a set of opportunities, which is really up to us, up to the businesses, up to the government to come up with smart solutions to maybe capitalize on these opportunities. Now, when we look at all this from a transfer pricing perspective, now there is, as we all know, an intrinsic link, that a relationship that transfer pricing has with business. The very concept of arm's length price requires a reference to the business realities, requires a reference to system profits, requires a reference to comparability, comparable data, and so on. Today we have a very esteemed panel, Mr. Sanjeev Sharma and Kunj Vaidya. And the way we have structured this presentation is a panel discussion around essentially four themes. And there are questions around each of these four themes. The first one being the midterm and long-term impact of COVID. The second is to do with issues around comparability, which inevitably will have to be faced when we deal with practical issues around benchmarking and analysis of the arm's length price. Documentation requirements, because that is always going to be key. Assessments are going to happen a few years down the line. If certain positions are to be taken, if certain adjustments are to be claimed, if certain changes to the pricing have to be undertaken, the reasons for that, the rationale for that will have to be documented today. What is the kind of documentation that one needs to do? And finally, we will talk about some of the initiatives that governments have taken around the world, and also from a India perspective. So this is how we are organizing today's session. Before we go into the session, I'll just quickly introduce our esteemed panel today. Both these gentlemen do not require introduction. So Mr. Sanjeev Sharma, as you're all aware, he's Principal Director of Income Tax Investigation. He has been an APA Commissioner for more than 5 years and has spent over 25 years in the tax administration, and most of his career in dealing with international tax and transfer pricing issues. Mr. Sharma has also worked as an advisor in the OECD Secretariat Paris for more than 3 years. He has represented the revenue both in the ITAT, in the Advanced Ruling Authority, at various committees, both nationally and internationally. Mr. Sharma has completed his LLM program from the international tax law in international tax law from the Vienna University of Economy and Business Administration. And Mr. Sharma is also working as a special advisor to the National Revenue Authority of the government of Sierra Leone. And I must add to this that personally, I have learned a tremendous amount from Mr. Sharma over the years, since the first time I would have appeared before him when he was the first transfer pricing officer in Mumbai, right to the time when I have represented before him in his capacity as an APA commissioner. And I can say that there are very few people with his knowledge and experience. And it's a privilege for me to make this introduction, and a privilege for all of us to have Mr. Sharma on this panel today. Kunj, as you're all aware, he leads the transfer pricing practice for PwC India. Again, a very, very learned professional. Kunj has been my friend for the last several years. We've been in the same organization, and Kunj has worked in different parts of the world, and he would have been working overseas during the time when the credit crisis happened, and there would be a lot of tips that we could get from Kunj in terms of how these issues were dealt with in overseas jurisdictions. Again, a wealth of knowledge, and we are privileged to have both these gentlemen. Before we begin, maybe I would just invite Mr. Sanjeev Sharma, if you would like to make some opening remarks, sir.
Thank you very much, Vaman, for your kind words personally about me. I also thank BCAS and team for organizing really this seminar on very important topic of the day or of the time, because everyone is concerned when the businesses are not working, not only in India but not working worldwide. The profitability or the revenues of the companies are going down, certainly will be going down. And it's not a short-term problem. It might continue for long. So this year, certainly 2020 is going to be not very good for the business. And only some businesses will be doing good, which is dealing with the health things, and other which is dealing with the consumables also. They will not be, I should not say that they will be doing good, but most of the businesses, because of this lockdown, and we are saying lockdown, but many of the countries have imposed national emergencies, and national emergencies where the businesses are also totally closed. So in such type of situations, certainly that the important thing comes in that, because intercompany pricing, the transfer price or intercompany agreement are drafted or are prepared, or the transactions in no time. Only the problem for the companies for doing the business will be the particular problem in the country, or some other problem, or institution, or innovation, or coming of the new product. But situation could imagine that such type of thing can happen, where the whole earth will be closed, whole businesses will be closed. And in such type of situations, that what will happen to the agreements which are existing, how those agreements will be really effective, will be applicable, whether the new agreements required to be done for this specific purposes, or those new agreements will continue for longer time. It is really a very big question for everyone. And organizing this event in this point of time, where many participants are there, it is really very good on behalf of the BCS. So I just thank them in the very beginning that this is a very good opportunity they have provided to me to share my whatever academic experience I'm having. Thank you very much.
Thank you, sir. So if we can jump into the first theme of questions, and the first point, in fact, Mr. Sanjeev Sharma, if I may direct the question to you, one of the concerns is that given this COVID situation, we are going to see a fluctuation in total system profit, most likely a reduction in the total system profit. And therefore, wherever there are arrangements such as limited risk distributors, how do you see this to impact these kinds of arrangements, and what kind of medium term, long term actions should be taken, should be considered to plan for this eventuality?
Thank you very much, Bama. This is really a very good question, because a country like India, which is a marketing jurisdiction or sales jurisdiction for many of the products which we don't manufacture, manufacturing capacities are not enough for the consumers or for the even for the businesses and all. So this is a very important question. I will take this question this way, that because everything in the transfer pricing is agreement. What was the agreement in the intercompany agreement about the remuneration to the Indian company or to the LRD, which you are saying? How the prices were set for the transfer price? That, see, transfer pricing, testing purposes, determining arm's length is totally different. The setting of the prices, how the multinational group sets the price when it is selling products in other country. So whether this is based on the cost plus for them, or it is based on the giving a remuneration, a fixed remuneration of some percentage of operating margin to the distribution company. So in a case where if in a case where the agreement was remuneration to the distribution company will be in the form of ensuring a certain operating margin. In that case, there was no reference to the global profit. There was no reference to the total system profit, whether it was in a loss or in the profit. That was affecting the profitability of the distribution company. But now certainly we know that revenues are going to fall. The total systems profit are going to fall for the companies. This is a known fact, and this is going to happen. When we didn't have this arrangement in the agreement earlier, it means that if there is an excess profit or there is a shortfall in the profit, that belonged to the parent company or the other companies which are outside the distribution company jurisdiction. So if it was kept as a totally separate from the system profit, then certainly there will be very difficulty until unless agreement is changed or functionality is properly brought down, and then there's a new agreement is brought up. Otherwise, it will be very difficult to ask for that, because system profit has come down, and then this remuneration for the LRD should be different. In this regard, so whether this is a COVID time or other than the COVID time, I think that, as I said, that agreement is most important, and agreement should contain what the various functions are, various risks are. What happens when the agreement is between control entities? Many things are taken for granted, because the subsidiary will be controlled, will be managed, will be directed. Everything will be done by the parent company. Subsidiary has a role of whatever functions it is required to functions. Those guidance for functions will also be from them. So these agreements are really not reflective of a third party agreement. For me, I think like this COVID situation will ask the companies, or will prompt the companies or multinational groups to really try to have now the agreements just like what will be the agreement in the third party situations. That the terms and conditions which should have been or which are in the third party situations, if those get reflecting, then such type of situations will not be required to be dealt with. So in this regard, a distribution company, if it is performing the functions, many functions, like if suppose it is responsible for the whole country, for marketing, for advertising, for logistics, for distribution, for pricing strategy, for each and everything. And as I said, the risks follows functions. If risks were being taken by this company, and by saying that it is a limited risk distributor, I think there will be a lot of thought now looking to this, that that the agreement which is drafted, which should reflect the terms and conditions which were or which should have been in a third party situations. Yeah, thank you, Baban.
Kunj, would you like to add something to this?
Yes, Vaman, sure. Thanks for that. And before I start, Vaman, you have been very modest of not introducing yourself. So thanks for your very generous introduction. Thanks to BCS for this opportunity and for everybody to join the call. Vaman, as you know, and as he also mentioned, is a very, very dear friend. We started our careers way long back, and very, very established professional in the field of transfer pricing. Most of you would know Vaman as well. So Vaman, a pleasure to be on this call with you. Coming to the question, sir, your points are very valid from a risk and functional perspective that one thinks about, and how the agreement is formulated to cover the risk and functional profile. Having said that, anytime a company or even in a third party situation, when you get into these agreements, the current situation that we are facing is absolutely unprecedented. Nobody could have even imagined a situation like this. Now, does that mean you have to ignore all the functional profile or the arrangement that was in place? I'm not saying that. Where I'm going with this is transfer pricing, as we all know, is at an operating level. And therefore, when you think about a functional and asset, functional profile, functional asset risk is also at operating level. The impact that we are talking about today, is that really at an operating level is a question. From a distribution, and if you were to look at a typical distribution, the impact could be multifold. There would be the top line impact to start with immediately. So the sales would go down. There itself, if one were to look at the argument that the Indian government has taken in the recent times about having a return for access to market, in a lockdown situation, you have taken away the access to market, right? That's one point. The other point, and that's really not in anybody's control, but it had to happen to address the situation. The coming to the cost side of it, there are multiple factors on the cost side. So in a distribution type of a situation, you could be impacted on inventory. There could be impairment on the inventory that you are holding. There could be bad credit that would happen, or a longer credit period that would get affected as well. There could be additional warranty claims. And above all, as we all know, rupee has taken a significant beating in last few weeks itself, and it keeps ramping up in that direction, unfortunately. The forex impact for a distributor on the import. Now, are these because of any affirmative action or a function performed by Indian distributor? The answer is no. At the same time, are these because of a function or an action taken by the principal and overseas? And once again, the answer would be no, because there was no action taken by them to result in this situation. And that brings you to a very uniqueness of, or it's a reflection of the uniqueness of the situation. Therefore, saying that, does this lie in the typical framework of FAR above the operating level or below the operating level? And one then needs to start getting into more specifics. I could not agree more with sir on how the agreement is laid out to start with. Is there force majeure that was articulated in there? Is this an abnormal event and cannot be really taken as a market risk? Was there an insurance for a situation like that? Just like there could be any event which is an act of God or anything like that could happen, extraordinary event for which there could be insurance. So these are various factors, and the answer would not be a cut and dry yes or no, just because if you are a limited risk distributor, therefore all and every risk. Remember, it is limited risk, it is not zero risk. And one has to go back to the functional side of it, just like sir said. Raman, I'll pause there.
I think extremely valid points, and I think one aspect of documentation, which many times is not given sufficient amount of attention to, is to discuss the industry overview. And I think in times like this, very important to really capture what are the industry realities, because your one size fits all approach will not apply in this kind of a case. I think merely making a claim that there has been a COVID impact will not be enough. One would have to really relate it back to how it affects the industry in question first. Then within the industry, what is the, and as sir mentioned, what has been the price setting mechanism that has been adopted? And the OECD also, the greater importance, and one of the themes coming out of the BEPS initiatives is you go beyond what is written in the agreement, what is the conduct of the parties, what has been the conduct of the parties, and is the action proposed today consistent with that conduct? At an operational level, perhaps one may also consider whether the fact that we are permitted a band of 35th to 65th percentile, maybe in times such as this, it would be sufficient to, let's say, all things being equal, target a 35th percentile and justify that in times such as this. But industry overview being, I think, is one area of documentation that should be given greater importance in these kinds of situations. So moving to the next question, maybe this is a question I'll direct it again to you, Kunj. There is going to be an inevitable impact of idle capacity, lower utilization. Now, how should companies deal with it? Whether they should take it as an exclusion from the cost base, or should it be treated as a non-operating cost? How would you think taxpayers should deal with it?
So, Vaman, this question in a way flows from the first question as well to some extent, because even limited risk distributors in a sense are service providers for the parent or for the principal companies. In a situation where you are talking about cost plus centers that we have, and we have many of them in India, uh, my sense is that one has to look at it a little more closely without jumping to the conclusion. There is certainly a merit in reconsidering the way. It is not business as usual for sure. One has to then look at what are these costs that we are talking about, right? What is this idle capacity that we are talking about? How did the idle capacity get triggered? So one obvious thing is, because of lockdown, people are not able to go to the office and therefore not able to work. Now that's one situation. In a situation like that, if you are not in position to render services, even in a captive scenario, why would, if it was a third party, transfer pricing end of the day requires you to step back and say, create an artificial construct, a fiction. If you were a third party, how would you act? And if you were to be in that situation, even in a third party situation, if you are not in position to render services, why would somebody pay you for that? So that's point number one, right? The other point then is, the one that we just talked about is very obvious idle capacity that we are talking about. Then there could be hidden idle capacities as well. People's ability to work from home is also impaired because of the available infrastructure as well. In our country, we have a lot of mobile workforce that comes from remote places, and in the lockdown situation, a lot of them have gone back to their native places. And are they able to have the infrastructure to connect from there or not? So the idle capacity itself needs to be answered in multiple ways, whether it is triggered from India's side. The other side of it is, did it get triggered from the overseas? Because the projects were put on hold. Now the projects were put on hold, why? Right? That becomes the next question. They were, because of C-19, they were also completely indisposed. It's not a willing decision to put projects on hold. It's a decision to put on hold because it's a forced decision. You could not really do this. Right, so that's another situation. So these are fact to be counted and countered while coming up with the idle capacity, and then say whether the cost base should be adjusted for that or not. I would again go back to the agreement as well, in what situation we are talking. Also look at what was our regular idle capacity. Every business has some sort of bench which is built in. So you cannot, everything cannot be just, combined in this, and this is an opportunity to not charge. That's not how one should be looking at it, but it has to be looked at very meaningfully and closely.
Thanks, Kunj. Sir, would you like to make any comments on this?
Yeah, no, Kunj very nicely explained this. I will just say that in this situation, certainly that is unable to meet the demand situation, or there is a less demand for the services. Okay, let us say cost plus arrangement in case of services only. If suppose there is no customer is not demanding that services and there is idle capacity here because the people, there is no demand, no services is required, or there is a demand but still we are not able to meet it. So in such type of situation, because if the agreements, if we see the agreements which have been drafted here in cost plus type of situation, that just says that the services will be remunerated based cost plus. And it doesn't, the agreement didn't talk of the service we are talking of. The utilization of the capacity we are talking, utilization of this, how the ramp up and ramp down of the employees are, we don't talk of that. We don't talk of the quality of the services. We don't talk of the turnaround time in the agreement. But all those are the master services agreement and the secondary agreements to that. So if we look into just into agreement for provision of services, it might be difficult to justify because of the situation, but certainly I say this is a very abnormal situation. Those agreements were drafted considering the normal situations and how those normal situations can be satisfied during the normal situations, how those conditions can be satisfied. They are totally abnormal situation. One can look for the revising the agreement or redrafting the agreement. And certainly because those agreements, because if we look into third party situations will not be on cost plus. Those will be on resources based or time based. Had those been on time based or resources based, this question of idle capacity would not have come. So I again say, if the agreement reflects the third party terms and conditions, then such type of situation would have taken care of. Yeah, thank you very much.
Sure, sir, absolutely. And I think at a practical level, one other aspect that taxpayers will have to take into consideration when whatever positions are being developed to defend these kinds of situations, what is the impact that it will have on their ability to claim these expenses as deductible under their as business expenditure, and that's something that will have to be borne in mind when preparing the defense and documentation. So if we move on to the next question, royalty management cross charges, these are any case areas of high interest from a transfer pricing perspective. There is a lot of litigation that we do have now, given a COVID situation where you're going to have profits under pressure. How do we deal with this? Do we explore a waiver or a moratorium? What is the impact in the hands of the Indian entity? What's the impact in the hands of the foreign entity? So maybe Kunj, I'll invite you to give your views on this.
Thanks, Raman. This is interesting. The first two questions were more a captive, low risk category that we were talking about. Now we are coming into more licensed operators, a bit of an entrepreneurial setup that we would think about, where you would have these charges, whether it's a royalty or a management cross charge. The way I look at it is, even more so, one has to go into the characterization. And before I answer how one would go into this, it's also important to note that the way you would act would have a bearing on how you were really characterized, right? This is in some ways a test of your characterization on how you will end up acting in this situation. So in a third party scenario, if there is a royalty, if there is a technology that is provided by anybody, they would expect a remuneration or a compensation for it. Of course, it can be linked to the market. And that's where the question then comes, that in a typical transfer pricing setup, we have always looked at cup analysis or cut analysis to benchmark royalty rates. Is that a true reflection of arm's length situation? Is that true reflection of third party situation? Or should it have been, or should it really be some sort of a residual profit split kind of an arrangement, which then allows to automatically adjust for this situation, right? Then you don't need to do anything differently because the results drive that. So that's one question to think about. I would not say that it would be a blanket moratorium and immediately you jump into it. Again, case by case, you will need to look into it, but certainly something can be explored. The reason I say that is one needs to look at the other side also. Transfer pricing is always a two-sided scenario. It's or even more than two-sided at times. So it's never only one side. From India side, yes, and India side, for that matter, any country defines arm's length as arm's length or better. So for that matter, you would obviously meet the arm's length standard if you were to have moratorium. But what happens on the other side becomes an important consideration. Cash flow becomes an important consideration as well in this situation, as a liquidity side of it, that by just simply putting moratorium, companies still need to keep investing into developing and innovating, even to overcome this situation itself. So is that feasible for them to and tenable for them to continue down that road? Couple of other parameters, Vaman, I want to just highlight and leave there is there is a there is an interaction outside of transfer pricing that one needs to be mindful of here. The moment you go down the path of moratorium or waiver, the question becomes: is it then a free of cost service from a GST angle? And therefore, there should be, how do I really look at that interplay? Now, this actually goes back to our LRD or the distributor setup also, that if I have a lowering of import prices, what happens to my customs side of it and the impact that I'm looking at. So there has to be a harmony between these two, or at least an attempt to harmonize the two, to make sure that trying to address the situation with one, you should not lend yourself into a problem with the other.
Absolutely. I think absolutely some very good points. So, sir, from your side, how would you look at it, and specifically, if you could, also speak to how this would be looked at from the non-residents' perspective in case a waiver or a moratorium is given.
Yeah, thank you, Baman. Certainly, if this royalty rates or the how the amount is to be computed, there is no failure of technology as far as this COVID is concerned. Technology has been provided. Technology can be used. It is they've created facility to create that to the technology. So as far as the licensor is concerned, he is not at fault at all. This is the licensee situation, that it is not able to generate revenue, it is not able to generate profitability because of these factors. Okay, so in this case, because related party comes into play in the sense, had it been a transaction between two unrelated parties, okay, that certainly whether the licensee could have gone to the licensor in a third party situation, please look into my situation, I am in very bad position because of this business reality, whether you can either use or pay the royalty or put a moratorium, or can you defer it? Can you defer the royalty? When good times come in, I will pay you back again, but my time is really very bad as of now. So here I would like to really compare with the third party situations, that in third party situations might be licensor would say, okay, let us both sync together, let us both float together. Okay, if you are not able to earn, if you are not able to do it, if it hurts your cash flow and all, okay, I will come for some solution. I think same way here it is a possibility, and if this is a well documented thing, that how high the royalty is reduced or moratorium is put or deferral is done, and if it is properly documented, I think other side also, tax administration of the other side certainly will agree to it. There should not be any problem, because it is not a one side problem. Has happened, and this is a situation which was not foreseen by either of the party. Otherwise, one could have said, okay, if my turnover is up to this much, then I pay. If my turnover is less than that, I will not pay. Such type of situations are not inbuilt in the agreements. Might be now onwards, as I say, that such type of situations may be built up in the agreements now. Thank you very much.
I think that's a very important theme coming out, sir, that the intercompany agreements being reflective of what arrangements would take place between third parties, actually does go a long way in being able to justify the pricing. And in this particular situation, if you have terms like force majeure built into the contract, that would definitely be of help. But if not, at least the contemporaneous documentation, that is, could be exchange of letters between the relevant parties to bring out the business difficulty, would help in justifying a waiver or a moratorium. Another interesting point, sir, that, moving on to the next issue around funding arrangements. Right now, we all talk about it's for many organizations, many businesses. The issue is right now not about profits, it's about funds, it's about having cash to be able to support their day-to-day operations, to be able to pay salaries to the staff, to keep the staff on the payroll. So under the circumstances, conserving cash and maybe moving cash from one entity to another entity, if you will have a cash surplus entity, cash deficit entity, moving that around is going to be important. Also, existing funding arrangements, whether there needs to be an interest renegotiation, again, waivers, moratoriums to support operations within the group. Sir, how do you see funding arrangements playing out in the medium to long term?
Yeah, Baman, here also the situation will be similar to what we are seeing in third question, this royalty and management charges. Because here also the lender has given the money to the borrower, and borrower is using that money and is not able to generate enough cash or to pay it. So in this situation also, the borrower will certainly will require to go to the lender that whether can you help us in this tight situation, in tough situation. And here I will say that yes, the other side of tax administration, certainly they will also be looking into this. If the interest rate were fixed at arm's length, then they are certainly going to object if there is a reduction in interest rate or is a waiver or moratorium. In that situation, my take would be that okay, let us look into a situation like Indian borrower. How we determine the arm's length price? We say, okay, this is the bank interest rate, looking into the comparable situations. This is the hedging cost which I will bear, and just bank interest rate minus hedging cost is the interest I'm paying to the lender, and in that case it is an arm's length. Let us look into the from the lender side. If lender has taken, if it is using its own equity or is having its own fund or is having a debt funding, then there is a cost of fund to them, that whenever they are lending to any other entity. And then cost of fund, what markup, if suppose is a cost of fund, if there is a high margin is there on the cost of Germany, or where the interest rates are, bond rates are negative, or other places. If you are having a very high margin on that, then certainly there is a chance that they can share that margin, reduce that margin, and can give a benefit to the borrower. And in case margin is there, that is being sharing, let us share half whatever is there. And so to that extent, if there is a cushion for reducing the interest rate, I think in that situations it should be done, and there should not be a big objection from the other side of the tax administration. Because yeah, as I said, if it is transfer prices from not from one side, we should look into from the other side also, whether they are earning more from the transaction. If more, let us also squeeze some of their margin. Thank you very much.
Kunj, how do you see this playing out, and specifically also with respect to the interest limitation provisions,
Yeah,
section B?
I missed that 94B because in case of 94B, that because the limitations are there, and because profit is going to be less, and the revenue will be less, then 94B is going to hit in most of the cases, and that will reduce. But certainly Kunj will be, will be able to add on it. Thank you.
So, Vaman, I agree with Sir's views on what he's saying, that one should look at, because transfer pricing is not a exact science. And like you also earlier alluded to the 35 to 65, there are always ranges and bands available. And if there is any movement possible in that to absorb some of these impacts, one should look at that as a group. But at the same time, arm's length is arm's length, and that needs to come into play as well. On the 94B particularly, I wanted to mention on the thin capitalization, and that's where this is more outside of transfer pricing a little bit, to say that as a country and as an economy, we will need the funds. And this deductibility pressure that we would have because of the profit getting squeezed in the current situation, there should be some respite given for that. Otherwise, it will be a very hard decision for the companies to take, whether I can continue to have this interest, but I'll not get deduction. I'm paying tax on the withholding side of it nonetheless, versus I will have some respite from this particular situation. I can continue to have the funds there. So that's an interesting one. Connected with funding arrangements. So what we talked about were some of the long-term funding arrangement, but at the same time, even short-term, we could have working capital arrangements, the trade credit that we could talk about, an extension of trade credit terms as well, both on receivable and payables, would also undergo stress as well as relook. And in times like this, again, something that should be looked into to say, if the normal credit period was 30 days, it will not be 30 days anymore. It would be a different term, and that needs to be considered while doing your transfer pricing.
Absolutely, I think that's a very valid point, Kunj. In fact, the RBI also has recently relaxed the period permitted for realization of export proceeds. So clearly something, while it is a temporary measure, it is clearly something that can be built in. And uh, the one other point that is going to be relevant from the funding arrangements perspective is whether the arrangement should be respected as a debt in the first place. I mean, many times the benchmarking, we people jump into the benchmarking and say, is the interest rate appropriate? But I think there is a larger there's a larger issue here as to whether the arrangement is funding is a debt to begin with. I think that is another area, given the stress that a lot of balance sheets will have. This is one area which will also have to be looked at in any transfer pricing analysis, that will, in a third party situation, would this have been debt in the first place?
But Vaman, on that, connected to that point, whether it would have been debt or not, just the difficulty in access to liquidity from the market would also lead to increased ask for guarantees, right? There could be parental guarantees that may be required. And are these then the next question will immediately come, are these in the nature of really parental and therefore an investor function because I need to stay afloat, versus is this a guarantee in a normal course of the trade and I need to have a charge for it? So that becomes another relevant aspect.
Absolutely. I think, if one really looks at it in simplistic terms, as a parent, it would be your obligation to bring up your subsidiary to, let's say, an investment grade credit rating. So to the extent that there is a guarantee given to bring up the subsidiary to an investment grade, possibly that is something that ought to be considered as a shareholder activity, and benefit, if any, from the guarantee should only be considered for any enhancement in rating beyond that. So I think the multiplicity of issues that are going to come up, and funding arrangements is an area where we are going to see a lot of complexities during this period.
So I know you are about to go to the next slide. I just wanted to make two quick points. One is connected to the funding, and then one just a little overall comment on this particular aspect that we are on right now. So on funding, one more thing is just the cash pooling side of it, right? Because currently there are a lot of limitations in the way the law is written and the different regulations interact, that even the multiple group companies within the country are not able to cross leverage the cash that is sitting in one pocket versus another pocket. And I think some unblocking of those would really help and go a long way for the companies to be able to leverage that cash and not necessarily take it out of the country, just to take it and put it in another pocket. So that's one aspect I wanted to cover on the funding side. And the other overall, to me, the theme really comes down to, you identified the intercompany agreement as a common link that we are talking about, and one needs to go back to that, which has to be looked at in tandem with substance versus form. That in reality, have you been really acting, and not limit yourself to the form only, either way, right? Either restriction. The other thing to me is operating versus investor function overall. So is this really a transfer pricing impact? Is this really a trade impact versus is this really an investor impact? And therefore, do I go back to the principal on the other side of the equation, or do I go to the parent on the other side of the equation? Back to you.
Kunj, you have reached a very important point. Is pooling thing. Pooling. I am on my, not as a tax administrator, but on personal level, I am fully for this, because See, whenever there are many companies of the group operating in a country, then one company takes a loan and paying high interest, and the other company is having a surplus and it is earning low interest or it is not using that money. Certainly, it becomes a very financial, not a good position. It becomes financially costly for the group. When we look into other world, we look into Europe, like whole of the Eurozone is having this cash pooling, that many companies which are in the different countries, they can come together in cash pooling, and cash pooling on day-to-day basis just keep overnight. Whoever is having surplus, whoever is having short, whoever is having surplus, it will earn the interest, and who is having the short, they will pay the interest. The cash pooling, that case should be made up, and certainly we are at that stage, such a big country, and many companies of the group. I think this should be I should not be any problem from the RBI side as far as I am concerned. I think this is the question, this is the issue which has not been floated. This idea has not been floated. This idea requires to be floated, brought to the knowledge of the policymakers, and I think that should be done.
I think, sir, frankly, the only limitation there is there are two parts, right? One is that would you take the nature of NBFC by giving money to another group company, and that's on the regulatory side. The other is on the income tax side. You have the deemed deemed dividend issue. I think if these two bottlenecks can be unplugged, it would really allow the cash to flow much easily.
Kunj, whenever there is a will for doing something, all side issues or all the regulatory issues requires to be relaxed. Okay, because see, those were made because see, when we are looking for this deemed dividend thing, loans thing, and all that thing. So might be that this we can certainly make it, and there will be checks for that it is not being misused for the purpose of dividend or for giving the hidden profit distribution and all. Certainly those issues can be looked into.
Thank you, sir. I think some very interesting points, and I think cash pooling is an area, and funding in general. I think this could be a topic in itself for discussion. But moving on to the subject that I would say, in a sense, is at the very heart of transfer pricing, which is comparability. And sir, my first question to you is, how do companies that are, let's say, wanting to set their prices, plan for financial year 2021? The impact of COVID is unlikely to be seen in a great measure in the results for even financial year 1920. So everything is really going to come in financial year 2021. So in planning for FY 2021, given that the comparable data available is all going to be historic data where COVID impact is not really visible, what is the practical solution? What should taxpayers be doing?
Yeah, certainly for the as far as the issue of transfer pricing, whether the transaction was at arm's length or not, that for the testing purposes later on when in come the assessment, by that time data of the competitors will be available, data of the comparable will be available. So that should not be or might be that the tax associations or the worldwide, there something comes out COVID period that how the transfer pricing need to be done. Might be that OECD comes out with this, or the governments also come out with some solution for this, and certainly India will be part of that solution. Well, as per the transfer price or the testing the arms is done. But I'm really very happy to know from your side that okay, how the prices should be set in this time. That how the prices. So my take would be that the way the prices were set in earlier time also, the prices should continue to be set in that point of time, and certainly the fair estimates can be made, and based on those fair estimates means which are reasonable, which are justifiable, which are fair, because the businessmen or the business people know that what is there, what the competitors are doing, what they are doing. I think if that is made, so the whatever data is available, whatever data point is available, that should be taken into account, and the price can. Yeah, I think I'm there. Yeah, thank you.
Kunj, your views on this?
Vaman, yeah, I was going to jump in. Vaman, you touched upon 2008 crisis some time back, and it reminds me of those times. And While you did indicate that I would have lived some of that, since I was in Houston, and at that time the oil economy was much better. Unfortunately, we did not get affected, at least on the stuff that I was working on. But every such situation is very different, right? Uh, and you can't really just pick from there and apply here. But it does give you some threads and basis to start as a starting point. So there were several economic models that were developed at that time to adjust for these things. If you look at past years historical data, 3 to 5 year data, could be longer depending on the industry and stuff. But look at that data and then apply some economic modeling to come up with at least a starting point. Adjust those for some of the realities and nuances of what is being faced today. And again, it cannot be applied in the same manner to everybody, right? I mean, I give you some very simple examples which everybody can relate to on this call. Is even in one particular industry, the answer will not be same for everybody. You could have a supplier who is in green zone and is able to function, and therefore your business is able to function at least partially whenever it opens up, versus you could have some suppliers stuck in lockdown hotspots and not able to function, even if you are in the same industry, right? And these are nuances that needs to be taken into consideration as you go through this. uh, but the, but it will remain, to my mind, it will remain very dynamic. Fortunately, some of the listed company data will start becoming available on a quarterly basis as well, but you have to take it uh, with some skepticism. Not necessarily that whether people are reporting it rightly or wrongly. It's only a question of whether the full impact is visible in there or not. And here, my point would be that companies need to. This is my personal thought. Companies need to really look at the larger point of survival and economic impact and community impact before coming to worry about the tax impact side of it. And that's where the governments have to step in and say, we are going to give you the bandwidth and the leeway to work on and work with you to address this situation, and not stand there to waiting for you to falter. And I'm sure government will step up to that.
Thanks, Kunj. In fact, this sort of leads me to the next question, which is, around captive operations, and that does, in a sense, constitute a large portion of the assessees that are subject to transfer pricing in India. And given given the COVID situation, given the system profits under stress, how should captive operations, because on the one hand we have been saying that, look, they are risk protected entities, they will continue to get a markup regardless of what happens, but how long do you stretch that argument? Is COVID-19 impact, is it like enough of a black swan event to justify uh, lowering of these markups, or potentially, or at least for a period of time, maybe just remunerating them at extremely reduced markups? What are your views on that?
um, Sir, if it's all right, I will take it first, and then you can supplement, please.
Please, yeah.
So, Vaman, on that point, it's too early to really tell. And the reason I say too early to tell on how the economy would react or respond to this, we are already seeing early signs, right? To my mind, economies and the economic behavior is a reflection of people's sentiment, and how well and quickly we are able to turn around the sentiment, and the leaders are able to turn around the sentiments will determine how we come out of this. But today, when you look at all around, it's doom and gloom, and that's what you see. So everybody is trying to do that crystal ball gazing to say whether it will be a V shape or a U shape or an L shape recovery of the economy. And that's why I say that it's a little early to really tell how long this would go, and whether it is really a black swan. I mean, we all spoke about earlier on this call that in 100 years we haven't seen something like this. So I don't know, if you don't call this a black swan, what else could be a black swan, right? I mean, thousands of people dying because of this, an extremely unfortunate situation that we are in, the whole world coming to a standstill. So definitely we all hope and wish that the economy or the businesses start coming and the life starts coming back to the normal. The economy itself will take some more time to come back to, when I say normal, the old normal, right? What it used to be. There would be a new normal for some period of time for sure. And that needs to be reflected even on the markup. So let's say in a short to mid term, we are able to adjust for some of the shocks of cost side of it or idle capacity side of it. And people are able to go back to work and start working on all of that. But because of the economy hit that the whole global economy would have taken, we've already seen GDP corrections for everybody around the world. Expecting the same outcome on a profitability basis would not be tenable. Sir, your thoughts, please.
Yeah, I agree with Coach in the sense that because see, this is an abnormal situation. All these whatever markups or margins which are based on the normal situations, when the competitors were also earning compare earnings, this were set. But if the competitors or the comparable also have the less profitability because of this, then certainly that is going to reflect on the service provider. That's so certainly that, but it will be good to make a very strong case for that, not only from the point of view of the profitability of the comparator here, because see all these transfer pricing methodology that were based on the normal time. This is abnormal time, so might be whatever we were using the TNMM cost plus all. I think we can also look into that. Okay, how the pie, as we were very question, how the whole pie has got decreased, how the revenues have got decreased, how the means, because if the multinational group says okay, you continue to have the whole all number of employees, there should not be any firing, and even if there is a revenue is there, that the cost let it so this will be just like supporting, as we will come this issue later on, that how the governments are supporting if you are keeping your all the employees intact or not firing them, or yeah. So this will be I think certainly based on the comparability and also based on the profitability of the system profit as such. I think if someone documents properly, then there will be, because this is not the decision making of any individual or of any tax administration which decides the markup is decided by the business, markup is decided by, so if business is doing like that, that will be reflective of it.
Sir, a allied question to this. A lot of companies that are operating as captives, they have entered into advanced pricing agreements, and let's assume that there is some advanced pricing agreement is the term is still on, and FY 2021 is part of a covered year of an APA, and you have this very significant impact of COVID. Um, how would you see this interplay with the critical assumptions of the APA, whether this would enable the taxpayer to maybe ask for a revision of the APA? What are your views on this?
Yeah, so I think the situation in inbuilt in Rule 10Q, which provides for the revision or revision of the APA, I will just read that. So revision of an agreement, there is a change in a critical assumption or failure to meet a condition subject to which the agreement has been entered into. So there is no failure to meet a condition, because certainly there's coming for the revision that okay, such abnormal situation has happened and this was not factored into, and this was a critical assumption was already mentioning that FAR continues to be the same. There is no change in the FAR, and then the agreement continues. Now here, the functions performed, assets used, and risks assets used. Okay, if assets is the manpower, assets is whatever other assets are there, and those are not used properly, if the use of those assets has decreased, and the functions performed has also been not to the same level which were earlier, in that case one can take a plea that the FAR has changed. And if the FAR had changed, then whatever the markups were decided based on the, because this was a 5-year agreement, considering that the same type of, there will be, train will be moving with the same speed all the time. Okay, there will be 10%, 15% variations here and there that could be taken care of. But if revenue comes down by 40%, or the employees comes down or whatever, if there is a drastic change in the business, certainly there can be a case for the revision of the agreement, but certainly that requires to be justified. And in that case, what will happen to the, how the arm's length will be decided. So there the rules are already there, that it can be revision can be done. So there is a scope for the revision from both the sides. So it is a possibility. Certainly one can go with the information, with the proper comparability, with the proper data set, with the proper thing. I think that should be a possibility.
It's clearly, it's a possibility, but it's not something that is a matter of right. The taxpayer in question will have to demonstrate how this has impacted the industry and then make a claim approach CPDT.
Certainly, possibility means possibility can be 100 or possibility can be 0. Okay, depending on how the case is make up and how it can be substantiated. That is a possibility. Yeah.
So, Raman, if I can just jump in here, see, on the APA revision and renegotiation, one is what the law provides for the modification of the APA, revision of the APA. The other part is the critical assumption itself getting triggered as well, right? That this is not business as normal, which is one of the key critical assumptions that we think about, irrespective of the functional profile changing or not, because the whole industry scenario and the market scenario, which was the basis of arriving at the pricing, has changed, has undergone a change. One thing I must applaud on this call and share with with our audience also is that the APA office and the commissioners have already started reaching out and being open to discuss these matters. And that's extremely positive from a government side to say, how are we going to address that? They are not, and nobody is, unfortunately, very unfortunately, nobody is kept away from what's happening around, right? Everybody is seeing the impact on a day-to-day life. And so it's really nice to see that. I think that will happen. The only word of caution for all of us is to that in the past, we have seen certain positions being taken early on and saying, these are the positions for a certain industry taken, and we want to then try and follow it. And I can understand where they may be coming from as a tax office. It's not easy to have those differentiations on some of those points. But given the kind of situation we are in, every single company will have a different nuance and a fact pattern, which I alluded to earlier. And therefore, it would be that much more important to remain flexible case by case and not just have a set of parameters that, this is what we have done in this case and therefore we apply in this case.
I think Kunj, absolutely valid point. In fact, when I'm talking to my clients and I'm seeing a range of views emerging from certain cases where people are seeing this as an existential threat. At the other end of the spectrum, there are clients who are also seeing this as an opportunity where they feel that in response to the COVID-19 situation globally, there would be a pressure towards reduction of costs, and that creates an opportunity for moving certain jobs to India. So it's really facts and circumstances based. One really needs to see for the specific taxpayer how it is affecting them. Moving to the next point, Kunj, again, we all hope that we have a quick recovery from this, and this question remains academic. But in cases of closures of business, termination of contracts, there will be costs associated with it. How do you deal with these from a transfer pricing perspective?
Well, first, let's hope that we don't have that situation. And truly, fingers crossed that we are all able to survive and sustain through this situation with minimal impact, whatever that can be defined as, right? But let's hope it doesn't come to that. But in those eventualities, unfortunately, there will be some situations where we have those. To my mind, we would go back to the characterization question that we talked about and the intercompany arrangement and the agreement. Once again, substance versus form on how the real conduct has been. and not only the agreement itself to be closely looked at. And the third layer is the business reality of it, right? What kind of cost are we talking about? And I'll tell you what I mean by business reality. This is very interesting. This is where the point I earlier made on whether this is a operating, transfer pricing, trade related impact, and therefore the principal or the other side in the related parties equation should step in, or whether this is a question of survival and therefore the investor should step in as an equity side of it. Uh, and at what point is an influx point where the principal or the other side of equation, trade equation, says that I need you to sustain because for my business, right? And therefore I will chip in and we will share some cost. So that is where the business reality will have to be observed very closely, case by case again, to determine who takes that cost. Unfortunately, there's no one answer.
Sir, given your your vast experience and dealing with a lot of overseas tax authorities, and any comments that you would have actually on both these points, on the APA revisions as well as these closure costs, any your views, and also any international perspective that you would have on these?
So, Vaman, my
Yeah,
experience
as
has
per
been.
the APA revision.
Sorry, sir. Please go ahead.
Please, no, Kunj, please continue. Yeah.
Sir,
Yes, Kunj. Yeah.
all right. So my Vaman, my experience on both the items on the APA in the past when the 2008 happened, and even right now the interactions with some of the major revenue authorities where they are able to function. Let's understand some of them are yet to come back into functioning also, but where they are able to function, they are very open to going back to the table on the APA, taking the impact of this into consideration and making revisions as required. That's point number one. Second is, as far as the closure cost is concerned, I have seen in the past that the outcome has been quite principled. My experience has been from a headquarter perspective, and there, the tax office has taken a view that, look, if the decision was based on trade side of it, we will bear the cost, and we will not let that cost go down to the captive side of it. The difference between the two situations is that the impact was on more heavy on one side versus here we are talking about impact all around, and that needs to be factored in. Sir, back to you. My apologies.
No,
You.
perfect, Kunj. Uh, yeah, as far as the APA revision is concerned, because I really do not have that experience what Kunj is having of 2009, and by that time we didn't have the APA regime. And in other countries also, certainly APA revisions are there. It's not there. If there are changes in the facts and circumstances and the far changes there, business realities have changed, then certainly there are APA revisions. And in this situation, certainly that, see, if a country is following a APA regime, then it means that regime is conscious of the fact of the taxpayers. It is very collaborative and very cooperative attitude of working with the taxpayer. So it's a very good relationship between tax administration and taxpayer. And I'm very happy that Kunj says that the tax administration is already approaching that. Yes, we are certainly ready to discuss this issue of revision. And this is the way the tax administrations in the very positive or friendly means I should say business friendly country works. So revision certainly should be a possibility, and it will happen worldwide. I hope so. And as far as the termination of contracts is concerned, I will just go by the agreement, that what the agreement provides for. If the agreement provides that it's a cost plus arrangement and there is nothing linked to the revenue, not linked to the business, not linked to any other thing, that in that case, certainly till the business continues, and then the cost will form part of the cost base. I will just, let us say, the example of, here comes the issue of how the third parties would have kept the terms and conditions. Because for us, pricing is not the arm's length price. I think arm's length is how the terms and conditions in a particular contract, whether that is reflective of a third party situations. As I said in the beginning, let us say somebody created a new building, is having 1,000 employees, and the agreement says with the 35 days notice, I can withdraw the contract. whether that is a possibility. The person who has created the full facility for only one customer and say in 35 days notice, you can close down the facility. That is not possible. So that should be reflective of the business reality, that there will be a minimum 1 year or 6 months notice, and then also there will be tapering off, or all type of thing will be allowed, so that the service provider doesn't suffer the cost or doesn't suffer the impact of the negative business reality. Yeah, thank you very much.
So let's move on to the next set of issues, and there will be a bit of a overlap here, because we have discussed, while we were discussing the issues, we had dealt with some of these things. Uh, these are again at the heart of the transfer pricing defense, which is documentation, because ultimately what you will show to the tax authority during your assessment is what documentation you have maintained on a contemporaneous basis. Now, how does the taxpayer document some of the issues relating to a COVID impact? And my first question to you, Kunj, would be, how do I document that the profitability is not impacted due to intercompany transactions? Because we all know that in a transfer pricing assessment, the presumption is that profitability or lack thereof is a direct consequence of intercompany transactions, unless you are able to almost prove otherwise. So given the COVID impact, what should taxpayers do about this?
So, Vaman, in some ways, this is no different than the otherwise the exercise that we would do to identify what is the source of the loss that is getting generated. How is the profitability being impacted if it is not in line with the arm's length range that you would establish? So you would look at the cost line by line. You would look at the top line impact if there is. So, for example, if you look at a distributor, has there been a change in the import pricing? And is the gross margin impacted because of that? Or is it really the operating expenses that have changed? And then if the operating expenses have changed, is that because of an intercompany arrangement, because the related party enforced a certain policy that required you to incur those expenses? This will have to be case by case, because if you were to take these kind of limited risk setups, the entire profitability is based on intercompany. And there, it is very hard to tell that intercompany does not impact profitability, no matter what situation, right? But then you go back to what we discussed, that is that because of an affirmative action by somebody to say, we don't want to give you work, or we want to, we are not in position to give you work, right? There are two different aspects that we are talking for. At the same time, even if we want to give you work, you are not in position to deliver the work. And those are the reasons that will have to be documented. And it becomes slightly difficult, because right now, with everybody working from home, not having full 100% functioning and operations going on, which makes the documentation even that much more difficult. But a little bit of, it will have to be two-sided. The companies will have to step up a little bit to say, okay, here is a framework. Let me start capturing some of this information flow to be able to document and keep that documentation contemporaneous, so that when the tax office comes in, I have it. At the same time, the tax office will also have to be not that rigid about show me exactly this document versus this document to be able to show that, because everybody has experienced this, right? It's hard to negate or deny the reality of C19. So that's how I would go about and put the big picture, rocks, 80-20, try to explain those 80, and then have good faith for the 20 part of it.
Sir, your views on this, sir?
Yeah, I think I will just stick to section 92D and rule 10D. I think that takes care of that. If any changes are happening, if any price setting is there, price changes are there, then that requires to be documented. That regions requires to be there. And if any assumptions are there, if any price negotiations are there, if whatever changes have taken place, I think those changes requires to be documented, and why that is there. I think that documentation is the most important thing too, because as I said in the beginning that this may remain for some months or might be for 1 year. but this audit will become after 2 years. By that time, new tax officers will be there, new transfer pricing officers will be there. Unless you justify from the documents that these were the events, these were the situations which led us to the revision of the prices or revision of the arrangement, I think that requires to be. So it's better to be contemporaneous, document it, not for the purpose of testing later on, but how the prices are set, how the changes have been made.
Thank you, sir. And I think an allied question, so maybe Kunj, I'll direct it to you. Modifications will be required in transfer pricing policies. They may be done, be it cost plus arrangement, be it, distributor arrangements. What should be the timing? What should be the timing of the documentation? What is the nature of documentation? Should it be limited to what you put in in a transfer pricing report? Should there be exchange of letters? Should it be reflected in the board minutes? What would be your guidance on this?
So my guidance, Vaman, would be that you should be as contemporaneous as the situation permits. One has to weigh in the possibility and the priority of running the operations and the business before coming to proving the tax side of it and documentation. But at the same time, keep in mind that these things, or any of these, nobody has experienced this thing, but circumstances when Sir very rightly said the tax office will come in 2 years or 3 years later, we all tend to forget a lot of things very quickly and move on to the next thing. And that's why, as contemporaneous as you can keep this documentation on what is the basis of making decisions, how it was arrived at, even if it means some of the minuting of some of these calls, some of the recording of some of these calls and documents, having exchange of letter, like you said, Vaman, reflecting on your intercompany agreement itself, have some broad parameters. Does not have to be in a normal stance. You may want to go 1 to 10, but maybe 1 to 5 is sufficient. Maybe 1 to 3 is sufficient versus not having anything and then reflecting back later. So contemporaneous as much as possible as time permits.
Sure. Sir, we already discussed this point about waiver of interest, royalty, management cross charges. From an India perspective, this will be a positive, assuming that it is an Indian taxpayer who's making this payment. But from a non-resident perspective, who is the non-resident filing a tax return in India in respect of, let's say, the royalty or technical service fee income, how do you see this impact of a waiver on the non-resident specifically, and what kind of documentation would you recommend that the non-resident should keep for these purposes?
Yeah, Vaman, for me, for this, I will just say that both are the two sides of one coin. Okay, if there reduction has taken place in case of payer, then certainly payee is going to take that only, is going to receive that only, and the payee will account in its account there and claim the credit of taxes paid in this country on whatever withholding tax has been made. Okay, I think there is no justification. I am very clear on this. There is no justification to keep the higher price or higher remuneration or higher for the non-resident when the payment to that has been affected less. Okay, so this, one cannot say that arm's length price for the non-resident to receive should have been more than what I think the transfer price is for the transaction. And for the transaction, if transfer price has been determined, then that applies to both sides of the transaction, and that may not be acceptable to the tax administration of the other side. But the same tax administration, if it is concerned with the two taxpayers, one non-resident and one resident for the same transaction, there is no point of having the different numbers for that. It has to be the same numbers.
Thank you, sir. Sir, and coming to delays in payments, we spoke about RBI coming out with with relaxed terms of for collection of export proceeds. What do you think? Do you think that if, let's say, RBI is now permitting 150 days, if for that period, if a taxpayer in India were to receive receive proceeds within the period permitted by RBI. During this COVID period, do you think this would be something, an approach that would be permissible? I mean, we know that in a normal situation, something that is merely because something is approved by RBI, it is not automatically considered arm's length. But given given this COVID-19 situation, do you think a view could be taken, or what could be the other ways in which there would be a justification for any delay in settlements?
Yeah, I think one would look into first of what the intercompany agreement says. If intercompany agreement is silent on the receivable, that when it is to be, because if it is a captive service provider or the captive unit, then the responsibility or the obligation of feeding to this entity is of the foreign entity, because its cash flow situations and cash requirement will be met by the foreign entity. Even if RBI says that you can take in 150 days, but if suppose there are no cash is available, then certainly the foreign entity need to provide the money in time. So if we look into the business reality and the transfer pricing, I think transfer pricing needs to adjust to the business reality. And because if there's as I said, there is an abnormal situation that it is not that somebody, it should not be a case that the money of the company is lying in the debtors for no reason. Okay, if it is for no reason, then certainly that there will be adjustment on account of this money lying with that. But if there is a reason that there is a shortfall in revenue of the foreign entity, they are also suffering from the cash flow problem, and they are also having lot of debts and all that thing. If those things can be justified, that there is a very genuine reason for getting this payment late or becoming some payment late for some duration of time, I think that exemption or that is a possibility, because arm's length price is not a mathematics. Okay, it is not a something like that. That is, arm's length price need to be reflective of the business reality, and in that case, if it can be justified, I think that should be acceptable.
Moving on to our last point in this section, one of the issues that we are seeing is that in order to combat the COVID-19 situation, the at a headquarter level in several multinational groups, be it Indian headquartered or overseas headquartered, there is a significant amount of senior management time and activity that is taking place in relation to strategies and measures to plan for the COVID-19 impact. Now, inevitably, this is going to lead to a higher level of costs being incurred at a headquarter level. And from a transfer pricing perspective, it raises the question as to whether this should be regarded as a shareholder activity, or should it be regarded as an activity which is beneficial to the affiliates within the group and therefore ought to be charged out. I would like to invite both your views, both of you, to give your views on this subject.
Sir, please
I
go
think
ahead,
Kunj
sir.
is
I'll
having a
follow.
priority. No, you have the priority.
Sure, sir. I'll share my thoughts. Vaman, this is connected with a number of things that we have discussed, right? That transfer pricing is two-sided, and one cannot just look at one side and limit it there. Now, like you said, there could be more time that is spent on the other side. Is that more time related to the trade side of it, or is that more time related to making some strategic decisions along the side of whether we should continue the operation to start with? What kind of work we are talking about and activity and cost we are talking about, it does go back to the same old benefit linkage. Just because the quantum of expense increases, that should not change the character of the treatment that we are talking about. That is my thought.
Yeah, same with me, Vaman, that because there will be intra-group service agreement. Intra-group service agreement will be having the description of various types of services. And it is only as I said, the quantum might change here and there. There might be strategic decision making, and how the business need to be done, how the business need to be refocused, where the efforts need to be done, where the efforts requires to be less, and all that thing. So there will be teams at the headquarter who looks into worldwide businesses, and those teams cost will be going to the different jurisdictions who are getting the benefit from those things. So only because, so it will be the same parameters, same test will be applied, requirement analysis, whether you require a third party substitution if those services are not there, or whether you are getting a benefit out of those or not, and whether this is for the purpose of equity or ownership interest or for the benefit of the business. All those, I think the tests will remain the same, and the quantum is not going to change the deduction or the disallowance or the allowance.
Sure. So we are now getting some questions, but before we get into the questions, I would like to probably turn to one topic which is of perhaps a great deal of interest to everyone, and I will invite sir, if you can comment on the first question, which is what are the different measures taken by countries around the world to provide relief to taxpayers in the current situation. So what has been your experience, and if you can share some your experience around what you have seen other countries doing.
Yeah, thank you, Vaman. If we look into the COVID situation, which is started in December, it started affecting the countries. So the way it started affecting the countries, let us say first European country, South Korea, Japan, then to America, India, and other countries, and Africa also. So I think we should say that 140 countries or 150 countries. I was even able to see that a island like BCAS Netherlands sovereignty island, a very small island. Okay, so like Sabah, there is one island over there, and see the country of Sabah, they have the jurisdiction. They also declare emergency. Okay. So many countries are going, whether this is a lockdown or this is a national emergency or this is something one can have the different name, but the effect is same, that the business operations, the movement of the people has been restricted, and that type of thing is there. So depending on the type of country, that what nature of development it is, what type of economy it is, what are its main concern, what are its priorities, what is important for them to keep going. Depending on the particular country, the responses of the government have been varied, measured, proportionate, and as well as to meet the requirement of the people. So there is no like rebellion type of thing, or there's no accusation against the government that government didn't act fast or government didn't act. So containing the COVID, taking the effect, and at the same time to provide succor and assistance to the people, to provide the family, because they are passing through the tough time. So they should not have something uncertainty of the future. Of course, it is inbuilt in when the situations are like this. So countries have acted differently. Like developed countries, if we take the example of Denmark, Iceland, Ireland, or other Nordic country, or the Belgium, for them, they say that yes, let us say a very simple example, that the government will provide a subsidy for the wages. If a company continues to retain the people, or retain the employees, and do not fire them, then the government can take up to 70% or 60% of the wages of such type of organization, like MSMEs or small proprietary concern, or all, if we are having because there is no paying capacity with the employer if there is no revenue, if revenue has become less. So the subsidy for the wages. Then most of the countries have come out the filing requirements. Those have been delayed, those have been deferred. In some cases, even audit requirement, transfer pricing requirement, those have been deferred. So what they call of the emergency tax measures, I'm not talking of the other measures and all business measures for the support of the business, but how the tax measures have been there. Like some countries, even in Nigeria or even Kenya, they have taken measures. Like, so Nigeria say, okay, that there will not be any investigation against the taxpayers, okay, that we will defer the investigation against the taxpayer. Then there are some cases like tax payment deadlines have been increased, withholding tax which have been deducted by the companies because of the cash flow situations, they have been asked to retain and then to pay later on. Then some countries have even reduced the taxpayer debts, that is where okay, we are getting by 20%. Some countries, okay, no interest and no penalty is payable if you pay only that. That like our VSB scheme. Even COVID was not there, but with the scheme, VSB type of scheme, also countries coming out. Then there are, he said that the contribution to the systems by the employer. You say, okay, you pay less, you were paying more, now you pay less, and the balance will be paid by the government. Then there are I was really looking into one country which says that taxpayers are free to pay whatever tax they want to pay to the kitty of the government. Okay, they can pay extra. There is no limit on payment, because why it is so? Because if they are keeping the money, whatever money is there, then there is a negative interest on that. The value of the money is going to be less later on. So if you are keeping with the government to give some interest. So such type of measures. Then yeah, I said base subsidies always already I said. Then emergency based subsidy, many countries. Then some cases refund of VAT, like in our country also we say that refund up to 5 lakh rupee has been. So there are many major, then there are incentive for the particular industries, those are coming up. So these are the, yeah, many things which is happening worldwide.
No, that was very exhaustive, sir. Kunj, very quickly, any expectations that you would like to mention from an India perspective? What you would like to see coming, and what has already come?
Yeah, thanks, Swaman. Sir, that's a pretty good summary of all the global stuff that we are talking about. And India has already taken a few steps, right, in terms of extension of the timelines that we have already seen. Also, extension of validity of the withholding tax, lower withholding tax certificates. Also, extension of stay granted cases and the matters that are there. So there are expectation of refunds as well. So some of those are very positive steps that are already taken. Specific to transfer pricing, we have not yet seen any step taken in that direction, and that may also be a matter of, because there is nothing immediate on transfer pricing that would have really struck, and therefore it may be still in works. And so that brings me to the wish list, and I have a pretty long wish list that I wrote down here. I'll still read it out. One needs to be hopeful, but it's really important from a, yes sir.
Kunji, your wish list will be taken by the other governments, because no government has come out with anything as of now on the transfer pricing.
Sure, sir. So
the APAs and maps are likely to be delayed.
Sir,
Please, yeah.
I put it in a couple of different buckets. One is on the administration side. And I think the administrative burden, if that can be reduced, so very simple actions that can be taken there. One is, for example, just a little bit of flexibility on the comparability and the documentation compliance for this year going forward, because the impact of this will come in a later time, and the impact will be realized also in the later time. So that's on just creating some flexibility there on the compliance. Also on the 3CB, the 3CB filing, the whole requirement to have it certified by an independent accountant. Now that's an added burden in times like this, when auditors are already going to sign off on the accounts and will have related party information certified from an audit perspective, because things will be very backed up. And this year, in fact, the compliance season is also preponed by a month. So these are just very short-term and immediate administrative relief that I was thinking of. Also, from an auditing perspective, the tax audit that happens, transfer pricing audit that happens, if there could be some respite on that as well, to look at multiple period together, or let's say look at even tested party data together to bring in or reflect the impact of what we are talking about. Some of the other ones that we could also look at is safe harbor. So safe harbor has been an instrument which, while the government came in with very good intentions, and any policy, just like any other country, has to reflect what is the requirement and need of the country at that particular time. And today, the safe harbor can really be used as a tool by relaxing some of those measures to ease the administrative burden of a number of these companies, to say in one swoop you can actually cover a large section of companies and give them ease that we are talking about. The other one is we've already talked about APA, and we are seeing the APA commissioners, the way they are already starting to interact and be open to what we are talking about. That will go a long way in again giving confidence to the tax community or taxpayer community on getting certainty. Uh, Couple of additional ones, sir. There are actually three last ones. One is we again touched upon the 94B thin capitalization and relaxation, and those norms will also go a long way from companies' ability to have those funds, and which is a requirement for the country also. The next one is secondary adjustment, which has been a major challenge for a number of companies from a practical standpoint. And in these times, when you make certain adjustments, and if you have a risk of secondary adjustment at a later point, it makes things that much more difficult to plan. And right now, nobody can really plan beyond a month-on-month basis that we are seeing currently. Lastly, I want to touch upon the interplay, and we also talked about it before. Some guidance or some more pragmatic approach to look at whatever is done to address transfer pricing or the commercial side of it should not be caught into a net of other side of things like customs or GST, where I need to make sure that, you know, if I reduce my import prices here from a distribution perspective, I should not get hit with a customs valuation side of it that, hey, what happens to my customs because you've reduced your import prices, right? Or free of cost that we talk about. So to me, this is a list that I could come up with, and if some considerations are given around this, would go a long way in helping our economy to sustain through this.
Kunj, very, very good points. And on the transfer pricing side, I just had one more suggestion to this. Perhaps on the APAs, if they could consider introducing the term test as opposed to
Yes.
compliance test, that could be something which would be a welcome move. For everyone's benefit, a term test is where you satisfy the APA condition over the term of the APA, and if you are unable to satisfy it in any 1 year, that itself does not constitute a violation of the APA, so long as you're able to satisfy it over the entire term of the APA. Again, while all these measures are there, I think I would hope as an Indian, I would hope that the government really comes out with a makes a concerted effort to attract as much of manufacturing to our country, which would lead to creation of jobs. Because it is, you do hear on the international media that, companies that have got manufacturing hubs in China, they are looking at, de-risking, diversifying that. But it's unfortunate that when the countries that get mentioned, you hear Philippines, you hear Vietnam, you hear Indonesia, you hear Malaysia, but you're still not hearing India in with the same level of enthusiasm. So I think that is one area which is, of course, it's a larger issue, which I hope the government will focus on. I think let's move on to the questions that have come from the participants. I'll take them sequentially. The first one is, how do you compute abnormal situations? Fixed. Sorry, I just lost that. The question was basically, how do you calculate abnormal situations? The fixed versus variable cost ratios are not visible from financials. That was the gist of the question. So maybe Kunj, would you like to take that?
So the answer to that, Raman, in my mind is, the abnormal cost is not something that you need to benchmark. The abnormal cost is your own abnormal cost that you are talking about, and to that extent, you have visibility into a lot of information for the tested party. Go into the data line by line as detailed as you can, and to be able to call something abnormal, first thing is to create the baseline of what is normal, and then differentiate vis-a-vis that to say this is abnormal and link it up. Uh, Anything we do or any abnormal cause that is identified then must be backed up with what kind of evidence you may be able to support it with, which will go a long way in getting you the certainty in longer term. That's my answer, Ram.
I think on a lighter note, Kunj, now we have the word normal, abnormal, and there's a new term called the new normal.
New
So
normal.
The next question is Indian revenue looking at allowing wider range for comparability? That is, rather than 35th to 65th percentile, will it be changed to 25th to 75th percentile, which is basically the interquartile range, which is a globally followed practice? I think, of course, this will require a legislative change, and it's not something that may not happen in the shorter term. But maybe I'll just, sir, if you want to answer this question.
Yeah, thank you, Vaman. I think it's everyone will raise such type questions, that why we are not following the interquartile range and why this 35th and 65th invention is there. So certainly there was a committee which was having representative of everyone looking to the, because all this, what happens that in the issue of comparability and in the statistics and all these things, what is required is that what type of comparable we are having, whether we are having a good number of comparable, whether many competitors are there, many people are in the business, and it will be able, they will be able to establish what the normal is, what the benchmark is possible. In our country, when we know that the not many real comparable come in the picture, and that's the reason if we keep the 75th and 25th, might be most of those will come in within the limit. So this was after a very good discussion, after pragmatic thinking, after analyzing the data in various sectors and all, and that was thought that okay, this is going to represent a good number of good amount of arm's length if we keep between 35th and 65th, and that will, because median will reflect the certainly the arm's length price or something. So it is after a lot of research. I think it may continue for some time, and if suppose something the data set becomes more, then one can go for those also.
Okay, we have probably time for another question, so I'll just take this. Uh, on a practical front, whether tested party multiple years data could be taken for comparison with comparables? Multiple years data given current year's data would not be available. So I think, Kunj, you briefly mentioned this point, and maybe I'll invite you to take this question. And we are all mindful that this is not what is permitted under the rules, but Kunj, maybe you can just speak to this.
Aman, most of these questions you can answer just as well. Uh, my view, my view is, like you rightly said, that the law has limitation in allowing use of multiple year tested party data. But I think when we think about the larger intention of establishing comparability, end of the day, you are looking at establishing comparability, right? The law was drafted not to limit you in doing that. It was drafted to help you and guiding towards doing it. And so as long as that larger purpose is being driven to say, how do I establish the comparability in the current situation? I see a lot of merit in using that as a guiding principle, at least to start with, right? Sir, what would you think?
No, I think this is fine, that because see, if we are comparing, testing the results for a particular year, then how the competitors or how the comparable have behaved, and they were also financially how they were in that year. So I think that is the reason that we look into the current year or the same financial year analysis. I think that is because that will really help in the COVID type of situation. If we were looking into, instead of 1 year, if we were looking into 3 years average, it could have been a difficult problem. So if it's a normal situations, and certainly when the business continues with the same, there's not much disturbances, much changes, then certainly that, so it all depends on industry to industry, country to country, everything will be different.
Vaman, something we must add to the wish list.
Absolutely.
Yeah.
Okay, I think I'm just conscious of time. Maybe one last question. Safe harbor rules from FY 1920 onwards are still awaited. This is a question to you, sir. The participant has specifically said, can we expect margins and conditions to be rationalized?
Certainly, when due, those will be coming in and looking to the situations that the committee will be looking into that, and let us hope that those good numbers, whatever comes in.
Sure, sir. So I think there are a lot more questions which we can, separately respond to them. But given the, given the time, and we have the benefit of Mr. Sanjeev Sharma being here today. If sir, if I can request you to spend a couple of minutes, a few minutes on touching upon the impact of MLI, because that's a topic of interest to to all of us. And if you can spend a few minutes on that, that will be very helpful.
Thank you, Vaman. I think the MLI, because why it was required, because when the BEPS section results and BEPS reports came, then that had many recommendations that those requires to be implemented in a fast pace. And if two countries, because if we look into that renegotiating a tax treaty or even changing a very small provision of the tax treaty is a very long and lengthy procedure. And if suppose all the countries were left to their own and to implement these measures, then it could have taken years together to even implement those measures. That is the reason that one of the action plan was that whether we can have a multilateral instrument where all can come together and they can sign and they can select that which of the agreements will be covered and which will not be covered, what type of article will be covered, will not be covered. So this is a very good, because the first time in the international tax situations for international, this had been practiced and this has come into being, and I'm really very happy that this has come into effect. And now I should say that there are now 94 countries which have signed this MLI. And as far as the India is concerned, India was one of the leader in this agreement, and India signed also. Then India ratified, and it also became effective. So India became effective means entry has come into force on 1st October 19. Now, what will be the effect? The effect will be that India is having the covered agreements with whatever countries are there. And if those countries have also considered India as a covered country, then in that case, that agreement, whatever the double taxation treaty is there, that will be modified to the extent which is provided in the MLI. So I think this is a very, because it's a very big topic in itself, that the how MLI is going to affect the existing tax treaties, and how the businesses need to take that into account. So for that purpose, most of the countries, they have come out with a synthesized version of their tax treaties, and those treaties should be taken into account, because there is a entry of coming into force, then which provision will be effective from which time. I think that the taxpayers, the businesses and the consultants need to take into account. It is not only the tax treaties but modified by the MLIs, and I suggest that can be a separate topic for the full discussion for 2 hours or so. Yeah. So thank you very much.
Thank you. I think that concludes our session. I will maybe hand it over to Shreyas for a vote of thanks. Thank you very much, Mr. Sanjeev Sharma. Thank you very much, Kunj. It was extremely illuminating and really enriching for all of us.
Thank you, Vaman, for being such a nice host, and Kunj for being together. Thank you very much.
Absolutely my pleasure, sir. It's an honor to always be alongside you. And Vaman, thank you so much. Once again, thanks for stepping in last minute. Really appreciate that.
Thanks to Vaman, Sanjeev ji and Kunj for an excellent exposition on the subject. My request Shreyas to propose a very well deserved vote of thanks to our distinguished panel.
Sure. Sanjeev sir, Kun sir, thank you very much for making this panel lively, engaging, and worthwhile. And Vaman sir, thank you very much for setting the tone, the pace, and the control of content. Really like the way it has been taken care of. Of course, in these times, the documentation and the actions comes out to be as reflecting the arm's length behavior, and that's what the content is coming out to be. But thank you. Please, thank you for we propose a vote of thanks. Thank you very much.
I must thank Shreyas Darshak Shah for taking a lot of efforts in putting up this panel, and thanks to Bhavesh Dedia, who has also been instrumental in putting this panel together. Thanks to Vaman for excellent moderation, and to our distinguished panel for brilliant answering. And thanks to all of you who are watching this online panel discussion. Thank you for joining in big numbers. Friends, I invite you to join our FEMA refresher course starting from the next week. And thanks to all of you once more. We'll meet again. Thank you.
Thank you.
Thank you.
Stay safe.
Thank you, everybody.